Hi, everybody. It's Dr. Robinson. This is the weekly meeting of the Money Masters Investment Club for December 17th, 2022. Not a lot to talk about today. We're just going to do our basic itinerary, talk about our financials. We'll update you there, and then talk a little bit about the market update or some market news. Nothing significant there. I think I've only got one thing I wanted to look at other than our bonds. So the one thing most people are interested in are financials. We had a really good week last week. The charts have been spot on, so we're kind of killing it right now. We started the week at 24.18 on the NAV. We gained $1.23. We ended the week at 25.41 for a 5% increase for the week. We took advantage of the volatility in the markets. The markets have been trending down for the last few days, especially since the Fed made their announcement recently. So we've been taking advantage of it, and it's been paying off. So we're doing really well on our puts. I do have to take a little bit of money back from that real gain because we did also we had redemptions, and I knew they were coming. And I've asked you guys to tell me in advance when you're going to take a redemption because I've got to try to plan for it. So it did cost us 18 cents on the redemption. So we had to sell some calls. Our calls were coming down in value from the market coming down. So I decided to get rid of the calls as opposed to the puts. I could have redeemed either side. You generally redeem the side that's not doing as well. Of course, the calls weren't doing as well because the market's been coming down. So calls right now, as of once I took out the distribution, the calls are now out of the money by 23 cents. They're relatively new, so in and of itself, that's not a meaningful number because we did this just a few days ago, within the last week anyway. Puts are in the money by $1.71. So as of right now, we did take a bunch of gains, or we had to modify our net position here. So right now we're up $76,483.17. We used a bunch of those profits for the redemptions. So our net impact on the NAV was 18 cents total. So our new NAV is officially 25.23. So I showed you the NAV, the previous NAV on the previous screen, just to kind of give you an idea or help you understand what we did for the week. But this kind of has to be added in as a net to the total position. So even though we were up 5%, we did have to take 18-cent loss on the redemptions for the week. So it did impact our NAV by just a few cents. We've been following interest rates, and you can see that interest rates are continuing to be fairly volatile, but the bond market is actually still continuing to go up. We're seeing a little bit of a pullback in the long bonds, but bond investors probably wouldn't be jumping to any long bonds anytime soon. Long bonds are what you get into once you're sure or once you're in a recession. So as you lead up into a recession, we tend to go to the shorter bonds, the 1, the 2, the 3, and maybe a 5. So you can see those have kind of, especially the 2 and the 3, those have decreased quite a bit on the basis points. And remember, again, and I say this all the time, but just to remember, whenever the interest rates go down, that means the bond prices have gone up. So you see on those major bonds are the 1 year, the 2 year, the 3 year bonds. So we had 450 basis points, not 450, 4.5 basis points decline, 5.2 on the 1 year Treasury, 6.3 on the 2 year Treasury, and another 4.5 basis points or bips on the 3 year Treasury. To help you understand a little bit, by the way, that translates into about a $20 gain on the bond. So anybody who bought bonds during this period, or you pay $1,000 for a bond, so those bonds are about worth in just a matter of 2 days, 1,020 or so. So they're up about $20 in value. Plus, you have a coupon on them of 4.182%. So the bond market, kind of, as I said in the meeting earlier this week, or in that little video this week, the bond market is kind of screaming out to us that it's no longer about the Fed, it's about recession. And bond investors are starting to really price in recession. that is going to mean that eventually stocks are going to have to be repriced again. They've been repriced a little bit in terms of expected earnings, the earnings decreases, but I don't think that most analysts have kind of done enough. They took the earnings down by about 7 or 8%, but I think they have to take them down about 15 to 20% to give us a better picture of what this is going to do, or what impact the recession is going to have. And of course, that's going to significantly track lower for stock prices. So um, we're still kind of holding off on getting back into the stock market based on this. I've got some stocks that I kind of want to recommend to my clients. It's just not the right time. So I'm kind of saving them. I'm holding them here in my back pocket, so to speak, until it's a better time to get into them. We'll probably have more clarity in the market by the middle of next month, maybe towards February. Of course, we got another Fed meeting in February. Not real sure what the forecast is in terms of an interest rate increase. I think there's going to be one. There are some people talking about there's not going to be any more, but you'll notice in the upper left-hand corner here, we got the Fed funds rate at 4.33. And if you remember from Jerome Powell's conversation a few days ago, he said he expects the Fed funds rate to get up towards 5.1. So we're still, I'm going to call it 70 basis points from where he said the terminal rate might be. Now, I would, if in fact we're at 70 basis points from where we want to be, I would love to see Jerome Powell do it in one fell swoop. I'd like to see him maybe in January, or I'm sorry, February, raise the interest rates by a full 70 basis points, maybe a 75 basis points increase again, maybe get it to 5.15 or something. I'd like to see him do that way. He could kind of calm it down a little bit. So maybe he can give some clarity to the markets and not have to raise interest rates into the meetings, let's say in March and April and stuff. So my hope is that I don't think he's going to, though. I think what he's going to do is probably in February, probably do another 50 basis points or maybe 25 basis points, who knows. But I think he's going to do kind of smaller ones and then kind of see how they're affecting the market overall. Personally, I think it would be better if he just did the whole thing right away. We're only 70 basis points away from what he said is terminal. Now, I know that he said that, it's not written in stone, by the way. Remember Bullard, the Fed president out of St. Louis, has said that he thinks that the rate, the terminal rate would have to be closer to 7%, to actually a tad over 7%. We don't really know. But if the Fed president is pretty confident of that 5.1% Fed funds rate, we're not that far from it. He can kind of knock it out real quick. So again, my hope versus what the reality is. We'll have more clarity as the month goes on. We got more CPI numbers coming out, PPI numbers coming out in the next month or so. Before the next meeting. So we'll find out what inflation's doing and whether the Fed can kind of taper this or maybe even get to the point where they don't have to continue raising rates. Although, even though they're not going to continue to raise rates, they've implied, and again, I think I believe them, they've implied that they're not going to lower rates anytime soon. And that's where the bond market's kind of having a fit. The bond market believes interest rates have to come down. So as the bond market continues to believe that interest rates have to come down and the Fed keeps saying they're not going to bring them down, that's why the bond market has basically capitulated to the fact that there is going to be a recession. The only question now is how long is the recession going to last and how deep might it go? But we don't know the answers to those until something called time passes. So we've got time to sit back and see what happens. But I'm in the camp also. I believe that the Fed has kind of given up on the idea of not having a recession or trying to do, some people call it a soft landing. I don't think they can do a soft landing here, not based on what Jerome Powell said in his last meeting. So I'm in the camp too, and that's why I went out and bought some bonds for my older clients. We ended up buying over a 3-day period. We bought $27 million of bonds for my older clients because these are good rates, and we think that the rates are going to go down from here. And so they're going to make some pretty good gains on the capital gain side when those rates come down. But anyway, that's the bond picture for the moment. It's still murky. But we are starting to make some progress in terms of lower bond yields, which means higher bond prices for bond investors. And I think that continues going forward. It is, it's not an exact science, by the way. So there's a possibility that we could be wrong, or maybe we're too soon. There's always a fear that you're too soon into the market. So it's possible interest rates could go up from here, which for my clients would not be a great thing. But at the very least, we're not doing the long bonds anyway. We're only doing mostly short bonds, 1s, 2s, and 3s. And because of that, even if interest rates do go up from here, 3-year period, even if for those who have a 3-year bond, you can hold it for the entire 3 years and still get your 4.5%. Not quite 4.5%, but 3.9% on a 3-year bond, and not have to worry about taking a loss on the gain because hey, there's no reason to sell it as long as you don't need the money in the next 3 years. Most bond investors don't need the money right away. They keep it in there and they just keep reinvesting it. So that's the bond picture for the moment. You'll notice that some of the longer bonds have increased a little bit. So interest rates came back just a tad. So the 10-year Treasury, that's our most important bond, of course, still hovering around the 3.48. I'm going to call it 3.5% range. The spread between that and the 2-year bond still quite wide, and it has narrowed a little bit, but it's still quite wide, and it's concerning for the economy. But that's the bond picture. The only other thing I wanted to kind of mention was, and a lot of people still struggle with the idea of, there's a real possibility, especially with the bond market telling us that maybe a recession's coming. But a lot of people still have this idea that we're not going to get into recession because the employment numbers are too strong. And I've kind of talked about this in the past, and I don't think so. And the reason I say that is because we're still missing a whole lot of people in this country who aren't working for whatever reason. The labor force, and we'll go through some of these numbers here real quick, but the numbers themselves don't add up. And they don't add up to what the Bureau of Labor Statistics tells us about how many new jobs there's been this year. So, for example, if you notice that first bullet point says, since March of 2022, the U.S. economy has added a total of 2,692,000 new jobs in the U.S. Now, that's since March. The new jobs in November, this was just our most recent, and remember, employment numbers are always a month behind. So even though this is December, we get the numbers on the first Friday of every month. So on the first Friday of December, we got a number of 263,000 new jobs. Now that would have been for November, so it wasn't a December number. We won't get the December numbers until January, the first Friday in January. But in any event, it says we made or increased jobs by 263,000. But look at a couple of other issues here. So the civilian non-institutional population, let me explain what that is. So it's civilian, it does not include anybody in the military. The government keeps those folks separate because they're basically, they belong to the military and they belong to the government. So the civilian non-institutional, that means people who aren't in prison or in jail or whatever it may be. So the working population is 264,708,000 people. So in this country, there's, and by the way, the government defines anybody as a potential laborer, a worker, if you will, as anyone over the age of 18 and who is not in the military, of course. Now, of course, a lot of those, and don't get me wrong, when I say there's 100 million people missing, they're not all missing. That includes some people who are, let's say, for example, in college. So if you think about how many kids are in college this year, because they're over age 18, but they don't have a job. So even though we call them laborers, they're not really laborers yet because they're not yet ready to take a position. They may have a part-time job somewhere doing some work, but at the end of the day, they're not considered full-time employees because they're in school. But we do include them. So there's 264 million people in this country who are of the age to work. That basically means between age 18 and age 65, because that's where most people retire. Our civilian labor force is actually 164 million. And that's why I say when we talk at times, we say there's 100 million people in this country missing. The reason we say that is because there's 264 million people in the country who are of working age, and yet there are only 164 million people who are actually working. So the question is, where are those 100 million people? It's actually 100,227,000 people. Now, we know some of them are in college, of course. We know some of them are maybe stay-at-home moms, and they're just not going to go into the workforce. And of course, that's part of it. There are some people who've made a bunch of money, maybe in Bitcoin before Bitcoin crashed, and they became a Bitcoin billionaire or millionaire, and they cashed out, and now they're just sitting on a beach and sipping drinks with those umbrellas in them. There's a fair amount of them living in mom's basement too. So at the end of the day, there are 164 million people in this country who are actually working, although the labor force is 264 million. So we're missing 100 million people. Our employment right now, these are people actually have jobs today, 158,470,000. So this is the employment number as of the first Friday in December. Now, this is, by the way, I want to go back on that slide one time if I can, and it's not letting me. But the one thing I wanted to point out is those are the numbers that came from the Bureau of Labor Statistics. Now, I'm not a guy who follows the Bureau of Labor Statistics because their math is kind of wonky. There are times when their math just doesn't add up. So what I like to do, because I'm an economist, I like to just go to the Fed, because the Fed is, a bunch of economists who are putting together all the information we kind of need to make decisions about the economy and all that sort of thing. So when you look at the Fed, the numbers are strange. So one of the things we look at is what the Fed keeps track of is how many people are in the labor force, how many people have full-time jobs, and all that sort of thing. So remember, just a few minutes ago, we said that the Bureau of Labor Statistics said that there was an increase over the last year of, I think it was 2.692 million jobs this year. So, and then 263,000 just in the month of November. But that's a problematic year thing, because at the end of the day, when you look at the actual numbers by the Fed, and they keep track of everything, when it comes to the non-farm payrolls, there's 153,548,000. These are in thousands, by the way. So it's 153,548,000 people on the payroll. But look at the employment level. The employment level is 158,470. So 158,470,000 Americans in the workforce. That's where we get that 158 we were talking about earlier. That's how many people have jobs. You look at the one other thing, and the yellow line there at the bottom is people with full-time jobs. So that's going to exclude people who are, maybe they are in college, but they have a part-time job working at McDonald's, trying to get enough money to, buy books or whatever it is in college. So the employment level are people with full-time jobs. And you'll notice that that last number here is 132,320. So 132,320,000 Americans have a full-time job. But the problem here is, if you look at it compared to that last column number to the first set of numbers you see, not on the far left before that blue, but just from the March 1st, 2022 line. So let me go back through these. So the employment level was back in March of 2022 was 132,718,000 people. And according to the Bureau of Labor Statistics, we've added roughly 3 million new jobs since then. Remember, that number was 2,692,000. So let's call it actually 2.7 million new jobs have been created. But that doesn't stack up. We had 132,718 people working a full-time job in March, and right now there's 132,320,000 people with full-time jobs. There's fewer people today with a full-time job than there was in March of this year. We're not adding jobs. If we are adding jobs, they're part-time jobs. Look at the brown number there is the employment level. So in March of this year, we were at 158,458,000 employees. Right now, we're at 158,470,000. There is an increase, but again, it's nowhere near the 2.7 million new jobs that everybody claims. It's actually only about 12,000 person difference. So there has been an increase in jobs, but it's only by about 12,000. But since the number of full-time jobs has actually decreased, it turns out that these increased new jobs are just part-time jobs. So the part-time jobs are still kind of booming, if you will. There's a lot of people out there taking part-time jobs trying to make ends meet, but the number of people with a full-time job is actually getting worse. So when people say that we can't have a recession in an economy where jobs are so prevalent and anybody who wants a job can get a job, those numbers don't add up. So the Fed numbers, now, is there a difference between how the Fed calculates numbers versus the Bureau of Labor Statistics? Well, I guess there's always a possibility there is. I don't know why there would be, because numbers are numbers. It's not like we're going to use, a different formula for calculating a number. If we want to know how many people are working in the country, we just look and see how many people are in the country with jobs. We have payroll data. We have data from the IRS. We know who's got a job, who doesn't have a job. But at the end of the day, it's kind of tough to make these numbers meet up. So why is the Bureau of Labor Statistics coming up with these funny numbers? I don't have an answer for you. So at the end of the day, I don't know why they've got numbers that are so different. We have one last slide here on the just to kind of clarify those numbers. So the employment now level, and that was again March of 2022, was 158,458, and in December 158,470. Again, that's a difference of 12,000 new jobs. So when people start talking about, well, we've created 2.7 million new jobs this year, or at least since March, well, if you have, I don't know where they're at. They're invisible jobs, or they're no-show jobs. Maybe it's a good union job or something, a no-show job. I don't know, but there's only 12,000 new jobs. The number of people actually working in this country from March to December only increased by 12,000 in a nation where 264 million people are working age. That's a pittance. Full-time employment, and we talked about this in March of this year, it was 132,718,000. December, 132,320,000. That's a decrease of 398,000 jobs. So when people say, hey, the economy's okay, or people say, hey, Joe Biden is doing good on jobs, and by the way, I don't blame presidents for jobs. It's not presidents don't create jobs. They never have. They can do things to cause jobs to go away by raising taxes and doing stupid things with an economy, but presidents aren't responsible for job gains. So I don't like when he takes credit for creating jobs, but I'm not going to give him blame for losing the jobs necessarily either. It's just a sum of what's going on in the economy. But again, we've lost 398,000 full-time jobs since March of this year. So where did the 2,692,000 jobs go? I don't know. I think they're all part-time jobs. Now it may be that it includes maybe some part-time jobs, but also internships, or maybe a part-time job that turns into a full-time job, because that's a fairly common thing in the economy. But at the end of the day, the numbers don't lie. So it's not, we didn't increase jobs, or there wasn't 263,000 new jobs in November of last month. The numbers don't lie. I don't know how the Bureau of Labor Statistics can do this, but at the end of the day, the numbers are the numbers. So the argument that you can't have a recession in the current jobs market is patently absurd. We can easily have a recession in an economy where we're losing full-time jobs and adding only really part-time jobs to that. Because if you think about it, somebody's going to have to take multiple part-time jobs to make up for the income they lose from one full-time job. That was all I had, guys. So I am kind of in that block of people who think that the Fed is kind of giving up on trying to fight for a recession or fight a recession. They're going to go ahead and kind of go headlong into it. Whether it's the smart plan or not, I don't know. That's for somebody whose pay grade's higher than mine. Generally, you want to stay away from recessions, but the inflation juggernaut is a bigger problem. So I agree with the Fed that inflation is a bigger problem, because recession, if it gets out of control, it will spiral out of control in a hurry, and that could send us into a repeat of the 1930s, where you go into a depression and things are really, really hard to get out of once you get into that. So I agree with them that they've got to deal with the inflation, but they're still stubbornly saying, I think there's a way to fight the inflation and, stop the raising of interest rates, just give it more time. But I think they're overdoing it a little bit, but that's just a personal opinion. I don't have anything to back it on. The only other thing I wanted to mention in a slide, and again, just our meeting on 12/24. So I think that'll be our next meeting. But our next meeting will not be, the way I do it now on a video. I am going to record it, by the way. So I did get some comments from people saying they still wanted to be able to read it or listen to it when, at will, if they can't be there live. So we will record it. But our topic for this week, or our next meeting rather, is going to be our normal stuff. Plus, we'll talk a little bit about how to hedge a position for those of you who are trying to get into a position, especially. And by the way, this is good for bonds too. So you can hedge bonds too. So if you are in bonds, like I've got some of my clients, just in case there's a retracement and interest rates start going back up significantly, we can still hedge those too, so that we don't lose any money or limit our losses, type of thing. We'll talk about that in our next meeting. So other than that, if you have any questions, guys, like always, send me an email, text, whatever it is, and I'll get back to it as quick as I can. Other than that, we'll see you, for those of you on the call, we'll see you on Monday. And for the rest of you, we'll see you next week.